Every losing trade has one thing in common. The trader had no idea what direction the market was actually moving in before they entered. Not the candle direction, not the indicator signal, the actual direction of the market. That is what market structure tells you. And without it, every other concept in smart money trading is completely useless. By the end of this video, you will know exactly how to read market direction before you place a single trade, how to identify when that direction is changing, and how to use multiple time frames without getting confused by conflicting signals. Price never moves in a straight line. On any chart, at any time frame, price is constantly moving up and down in a series of peaks and valleys. Those peaks are called swing highs, and those valleys are called swing lows. Market structure is simply the pattern those swing highs and swing lows create over time. When price creates a higher high, followed by a higher low, and then another higher high, that is bullish market structure. Price is stepping up in a staircase pattern. Each push higher reaches a new high, and each pullback holds above the previous low. That tells us buyers are in control. When price creates a lower low, followed by a lower high, and then another lower low, that is bearish market structure. Price is stepping down. Each drop makes a new low, and each bounce fails to reach the previous high. That tells us sellers are in control. Reading this pattern correctly is the single most important skill in technical trading. Everything else builds on top of it. To read market structure, you need to be able to identify swing highs and swing lows clearly. A swing high is a candle or group of candles where price reaches a peak and then pulls back on both sides. A swing low is where price reaches a trough and then bounces on both sides. Not every small move counts as a swing high or swing low. We are looking for meaningful turns in price, not every minor fluctuation. The more significant the swing, the more weight it carries in our analysis. On the Euro-Dollar 1-hour chart, price creates a clear series of swing highs and swing lows stepping upward. Each new high is higher than the last. Each pullback holds above the previous low. That pattern tells us the market is in a clean bullish structure, and we should be looking for opportunities to buy, not sell. In a bullish market, price moves in a specific rhythm. It pushes up to a new high, pulls back to form a higher low, and then pushes up again to an even higher high. This cycle repeats as long as the trend is intact. The higher low is the most important part of bullish structure. As long as each pullback stays above the previous low, the structure remains bullish. Buyers are defending their positions. Every dip is being bought. The market is healthy, and the trend is continuing. When we see this pattern on the chart, our bias is clear. We are looking to buy. We are not looking for short setups. We are not trying to pick a top. We are waiting for price to pull back into a key zone and give us a reason to enter long. On the pound-dollar 4-hour chart, price creates 5 consecutive higher highs and higher lows over several weeks. Every time price pulls back, it holds above the previous low and then continues higher. A trader who identified this structure early had multiple opportunities to enter long at each pullback. Bearish market structure works in the exact same way, but in the opposite direction. Price drops to a new low, bounces to form a lower high, and then drops again to an even lower low. As long as each bounce stays below the previous high, the structure remains bearish. The lower high is what keeps the bearish structure intact. Sellers are defending their positions at each bounce. Every rally is being sold. As long as that pattern continues, our bias stays bearish, and we look for selling opportunities at each pullback into a key zone. On the dollar-yen 1-hour chart, price creates a series of lower highs and lower lows over several sessions. Each time price bounces, it fails to reach the previous high before rolling over again. That tells us sellers are still in control, and any bounce is an opportunity to sell, not a reason to buy.
Structure does not last forever. At some point, price will break the pattern. Understanding how and why structure breaks is just as important as reading the structure itself. In a bullish market, structure breaks when price drops below a significant swing low. That move below the swing low tells us that buyers were not able to defend that level.
The higher low that was holding the bullish structure in place has been broken. This is the first sign that the trend may be changing. In a bearish market, structure breaks when price pushes above a significant swing high. That move tells us that sellers failed to hold price down. The lower high that was keeping the bearish structure intact has been broken. Again, this is the first warning that something has changed. This break is what we call a change of character. It does not immediately mean the trend has reversed, but it does mean we need to reassess our bias and stop blindly following the old trend. One of the most important things to understand about market structure is that it exists on every time frame simultaneously. The daily chart has its own structure. The 4-hour chart has its own structure. The 1-hour and 15-minute charts each have their own structure as well. These structures do not always agree with each other. The daily chart might be in a bullish structure, while the 1-hour chart is in a bearish structure. When this happens, the lower time frame bearish move is simply a pullback within the larger bullish trend. This is why we always check the higher time frame first. The higher time frame structure defines the overall direction. The lower time frame structure tells us where to enter within that direction. If the daily chart is bullish and the 1-hour chart pulls back into bearish structure, we are not looking to sell. We are waiting for the 1-hour chart to give a change of character back to the upside so we can buy in the direction of the daily trend. The lower time frame structure gave us the pullback. The change of character on the lower time frame gives us the entry. On the euro-dollar daily chart, price is in a clear bullish structure, making higher highs and higher lows. On the 1-hour chart, price pulls back and briefly creates a lower high and a lower low. A trader who only looked at the 1-hour chart might think the market has turned bearish, but a trader who checked the daily chart first would recognize that this is just a pullback. When the 1-hour chart gives a change of character back to the upside, that is the entry point into the daily bullish trend. Market structure is what gives you your bias. Your bias is simply the direction you are looking to trade. If the structure is bullish, your bias is long. If the structure is bearish, your bias is short. If the structure is unclear or ranging, your bias is neutral and you wait. Having a clear bias before you look at any setup is what keeps you from taking trades in the wrong direction. Without a structural bias, you are essentially guessing. With a clear structural bias, every setup you take is already aligned with the direction the market wants to move. The higher time frame gives you the primary bias. The lower time frame gives you the entry. When both are aligned, the quality of the setup increases significantly. When they are not aligned, the risk of the trade is much higher. Let us take this to a real chart and see exactly how this plays out. On the pound-dollar daily chart, price had been printing higher highs and higher lows for several weeks. On the 4-hour chart, price pulled back and started creating lower highs and lower lows. A trader looking only at the 4-hour chart would have flipped bearish immediately. But the daily structure was still completely intact. The 4-hour move was a pullback, not a reversal. We waited. On the 1-hour chart, price tapped into a fair value gap left behind by the previous daily advance and gave a change of character back to the upside. That was the entry. Stop below the 1-hour low. Target the next daily swing high. The daily structure defined the bias the entire time. The lower time frames just gave us the timing. On the dollar-yen 4-hour chart, price had been stepping down in a clean sequence of lower highs and lower lows across multiple sessions. Price then pushed above a swing high for the first time. Most traders ignored it because the downtrend had been so strong. We did not ignore it. That was a change of character on the 4-hour chart, and it shifted the entire bias. On the 1-hour chart, price pulled back and left a fair value gap below the move. Price returned to that gap, stalled, and gave a change of character back to the upside on the 15-minute chart. We entered long from inside the gap. Stop below the gap. Target the sell-side liquidity sitting above the most recent 4-hour swing high. Structure shifted first. Everything else followed. The most common mistake traders make with market structure is switching their bias too quickly. Price will often make a small move against the trend before continuing in the original direction. If you change your bias every time price makes a minor swing against you, you will constantly be on the wrong side. Wait for a meaningful break. A genuine structural shift shows up clearly on the chart. It is not ambiguous. Price breaks a significant level, not just a minor one, and it is usually accompanied by a strong candle or a sharp move that leaves no doubt about what just happened. Also avoid analyzing structure in isolation. Always combine it with liquidity, fair value gaps, and order blocks to get the full picture. Structure tells you the direction. The other concepts tell you where to enter within that direction. Market structure is not a complicated concept. Price makes highs and lows. When those highs and lows step higher, the market is bullish. When they step lower, the market is bearish. When that pattern breaks, the market is shifting. That is all market structure is. Now that you can read market structure, the next question is why price never just moves cleanly in that direction. Why does it dip below swing lows in an uptrend before continuing higher? Why does it push above swing highs in a downtrend before reversing? That is not random. That is liquidity being taken. And understanding how it works will completely change the way you read every single move on the chart. That is the next video.